Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields still holding the range, the 280 to 290 range, very, very comfortably right in the middle, right in the meat part of that range, right near 285. I think there were some expectations that we could see yields creep higher. Obviously, there's risks. Still talking about trade wars, tariffs with China. You got the president overseas speaking with NATO. You've got data here and whatnot, but you continue to see the market kind of just tread water and comfortably trade in that range. Something it's done since late June. We haven't really seen a move, a big knee-jerk reaction in any direction. The market seems very content to hold it. Yeah, we've made some slow run-ups to the highs and some slow rundowns to the lows, but we haven't really seen any market sort of threaten to break out of this range. That doesn't mean it can't happen, and there are some things down the road that could cause that to happen. But right now in today's world, we're not seeing that. So as we hold the range, the market's showing no signs of cracking at this point. And one area I think that you could look at that will be of concern, obviously, remains the yield curve. 2 makes another new low since August of 2007. So you continue to see that 2-year note, 10-year note relationship get nearer and nearer to flat, which would be the ultimate, neon sign, recession, something that neither, investors or the Fed want, but certainly is something that is now on everybody's radar. As the curve continues to flatten, how will this be? How will this change anything going forward with Fed policy? And if you look at market volatility, despite all of the things I just said, despite the fact that we do have a lot of geopolitical risks out there, we've got economic risks, we've got earnings season, blah, blah, blah. Volatility continue to go down. And I think it's mainly because we are holding in that range, in that comfortable 280 to 290 range. We haven't shown any signs of the market cratering or rallying. It just kind of sits in that middle. We trade down, we come back up, we trade up, we come back down. And I think that right now, market volatility is as much a signal that the market has really no fear of a breakout, at least in the short term. Obviously that, like I said earlier, that can change very quickly. And if we look at what do we have coming out, we've got, we have PPI came out strong today that boosted some of the expectations for stronger CPI. That will be something that the Fed has welcomed. Obviously, inflation has been something that we've been watching and saying, when we get to 2%, when we get to 2%, well, we're getting there, and it looks like we could be there to stay at least for a while. And that could be something that really, puts a feather in the Fed's hat. We finally got the inflation numbers where we want. However, there is still a balance here, and if you look at the uncertainties moving forward, we've got Powell's testimony next week to Congress. We've got in the second half of this year, we have the midterm elections in the U.S. So there are going to be some issues, some macro moments that will take center stage. And right now, the uncertainties of the long term, I think, are taking over maybe the good news we're seeing in the short term. So we need to see more good news, and obviously GDP growth will be a big part of that as well. But until we see a move, obviously we're stuck in that range. If we see a trade below 275 yield, I think that's really going to scare a lot of these shorts into covering. Likewise, if we get north of 290, I don't see the market really seeing sellers come in with both hands. They are still short. Yes, I do see us pressing closer to 3% if we can get a sustained trade above 290, but we're a long way from there. And the way things are looking right now, it seems that the market is going to err on the side of caution, and that means lower yields in the longer term. This is Todd Colvin coming to you from the floor of the CME Group.